Imagine waking up tomorrow and opening your banking app, only to see one message: service unavailable. You try another bank. Same result. ATMs stop working, card payments fail. And within hours it feels like your money has disappeared. The real shock is not just the shutdown, but the realization that almost nobody has ever asked what would actually happen if banks stopped working. Most people believe their money is safely stored inside a bank, waiting whenever they need it. But in reality, if every customer demanded their cash at the same time, no bank could fulfill it. Not because the money is stolen, but because modern banking doesn't work like storage. It works on the assumption that not everyone will withdraw their money at once. Think of a huge theater with 10,000 seats. If someone shouts "fire," panic spreads instantly, and everyone rushes toward the exits. The exits haven't changed, but the behavior has. This is exactly what happens in a bank run. Banks are not built for everyone to withdraw everything at once. They are built on trust that most people won't. The truth is, your bank doesn't just store your money. It puts it to work. The moment you deposit your salary, that money is used for loans, mortgages, cars, and businesses. Your balance still appears on your screen, but the physical cash is already moving through the economy. Modern banking is built on circulation, not storage. Now, imagine millions of people hearing a rumor on social media that banks are collapsing. Even if it's false, panic spreads instantly. ATMs run out of cash. People line up outside branches. News footage shows long queues. And that fear creates even more panic. The system doesn't break from truth alone. It often breaks from belief. History shows this pattern repeatedly. During financial crises, people rush to withdraw money. Businesses try to secure payroll. Parents stock up essentials. And investors panic sell assets. But ironically, when everyone tries to protect themselves at once, they often trigger the very breakdown they fear. Supply chains slow, payments fail, and economic activity freezes. Almost everything in daily life depends on banking systems working silently in the background: coffee, fuel, shopping, bills, rent, salaries. We rarely notice it because it's invisible. But if that system stopped for even 48 hours, modern life would quickly reveal how fragile it actually is. Today, most money isn't physical at all. It exists as digital entries in banking systems. If those systems stopped, there wouldn't be enough printed cash to replace it. Money is no longer just currency. It is digital trust recorded in databases. And that trust is what keeps the entire system alive. In such a crisis, central banks step in. They inject liquidity, guarantee deposits, and try to restore confidence. Because their most powerful tool is not money itself, but trust. Financial crises are often psychological before they are economic. Fear spreads faster than any real collapse, and confidence determines survival. If banks stayed closed for a week, life would become extremely difficult, but society would not completely end. Cash would help at first, but even it would run out. Investments would freeze, panic would distort markets, and emotional decisions would destroy more wealth than the crisis itself. In the end, money is not just paper or numbers, it is trust. And knowledge is what protects you when that trust is tested. Even if banks shut down for an entire week, cash would only solve the problem temporarily. At first, people would rely on physical money, thinking it gives them control. But soon, businesses would struggle with change, salaries, and payments. Cash alone cannot run a modern economy, because the system depends on continuous digital movement, not static piles of money. When banking systems stop, even people with money begin to feel powerless. Salaries get delayed, suppliers are unpaid, and factories slow down. The problem is not the lack of wealth, but the inability to move it. Money only has value when it can flow freely between people, businesses, and institutions. This is where investments become vulnerable. Stocks, mutual funds, and pensions all depend on banking infrastructure. If banks freeze, trading systems struggle, companies lose access to funding, and investors rush to safer assets. Prices can collapse not because businesses fail, but because fear temporarily overtakes logic in the market. Markets are not driven only by numbers. They are driven by human emotions: fear, greed, hope, and uncertainty. These emotions move trillions every year. When fear dominates, even strong economies can look weak. When hope returns, recovery begins. The system is deeply tied to psychology, not just mathematics. Many people think keeping cash at home is the safest option during crises. But that comes with its own risks: fire, theft, and inflation. Even if the cash never disappears physically, its buying power slowly decreases over time. So avoiding banks completely is not a perfect solution either. The real approach is diversification. People who understand money spread their risk across different banks, emergency cash, investments, and even global assets. Financial resilience is not about predicting the future. It is about preparing for uncertainty and building systems that can survive unexpected shocks. But the biggest danger during any financial crisis is emotional decision-making. People often withdraw everything, in panic, or sell investments at the worst possible time. These reactions transfer wealth from fearful individuals to those who stay calm and think long-term. History repeatedly shows that patience is rewarded while panic is punished. Financial crises always create winners and losers, not just based on wealth, but based on behavior. Those who remain calm often recover faster and even gain long-term advantage when markets stabilize. If every bank shut down tomorrow, governments would not stay silent. Emergency measures would be introduced quickly. Central banks would inject liquidity, and payment systems would gradually restart. The system would not disappear, it would adapt, stabilize, and rebuild confidence step by step. In the end, money is not just currency. It is trust organized into a system. Banks are part of that system, but understanding how it works removes fear and builds confidence. Real financial strength comes not from how much money you have, but from how well you understand the system when others panic. Now zoom out and look at the bigger picture. Modern money is not just something you hold in your hand. It is a massive, global system built on interconnected trust. Every transaction, every salary, every purchase depends on thousands of invisible systems working together without interruption. The moment one layer fails, the impact spreads far beyond what most people imagine. Banks are only one part of this system. Behind them are central banks, payment processors, digital networks, and international financial institutions. All of them work together silently in the background. Most people never see this machinery, but it is constantly moving trillions of dollars every single day across the world. Because this system is so smooth, people forget it can fail. That is why financial crises feel so shocking. One moment, everything works normally, and the next moment systems slow down or freeze. The illusion of permanence disappears instantly when trust is questioned. Even during panic, the physical world does not stop immediately. Shops still open, people still go to work, and life continues, but financial friction starts appearing everywhere. Small delays in payments grow into bigger problems, showing how deeply money systems are tied to everyday survival. As uncertainty grows, governments and central banks become the stabilizing force. They can guarantee deposits, provide emergency funds, and restart frozen systems. Their goal is not just to fix money, but to restore confidence so people begin trusting the system again. But confidence cannot be forced, it must be rebuilt. Even after systems restart, people remain cautious. They slowly begin using banks again, testing whether everything works. Recovery is not instant. It happens step by step as trust returns. Over time, financial systems stabilize again. Transactions resume, businesses reopen fully, and economic activity returns to normal. But after a crisis, people are never exactly the same. Awareness increases, and the invisible system behind money becomes much more visible in their minds. One of the most important lessons from any financial shock is that fear spreads faster than facts. A rumor can move faster than official confirmation. That is why financial systems depend so heavily on communication, transparency, and public confidence to prevent panic from escalating. In reality, banks are not designed to be perfect. They are designed to be stable under normal conditions. The entire system assumes balance. Some people deposit, some withdraw, and money keeps flowing. Problems begin only when that balance breaks due to panic or extreme events. So if you ever think about your bank balance, remember this: it is not just a number sitting somewhere waiting for you. It is part of a living system powered by trust, behavior, and confidence. And the strongest protection you have is not just money, it is understanding how that system actually works. Most people never realize how dependent the global economy is on continuous trust. Every second, money is moving across borders, industries, and systems. If that flow slows even slightly, it creates ripple effects that touch supply chains, salaries, and prices in ways most individuals never directly see, but always feel. Even everyday businesses depend on this invisible system. A small shop, a delivery service, or a freelancer all rely on banks to process payments instantly. Without that speed and reliability, even simple transactions would become slow, manual, and uncertain, changing the entire rhythm of daily life. When systems fail, uncertainty becomes the biggest problem. People stop spending, businesses stop investing, and everything slows down. This hesitation creates a chain reaction where reduced activity leads to even more uncertainty, deepening the overall slowdown. In such moments, governments focus heavily on restoring confidence. They issue statements, guarantee deposits, and ensure that people's savings remain safe. The goal is not just technical recovery, but psychological stability, because without trust, even a functioning system feels broken. Central banks play a critical role in this process. They control liquidity, stabilize financial flows, and ensure that banks can continue operating. Without this support system, small shocks could turn into large-scale crises very quickly. One of the most misunderstood ideas is that money exists independently of systems. In reality, money is a coordinated agreement between institutions, technology, and people. If any one of these breaks, the entire structure becomes unstable, even if physical currency still exists. This is why financial education is so important. Without understanding how money works, people are more likely to panic during uncertainty. But those who understand the system can make calmer, more rational decisions even when others are reacting emotionally. Financial crises are not only economic events, they are behavioral events. The same system that works perfectly during stability can feel fragile during fear. This contrast shows how deeply human psychology is embedded in the structure of money itself. Even after a crisis passes, lessons remain. People become more aware of risk, more careful with investments, and more attentive to financial systems. Over time, these experiences shape stronger habits and more resilient financial behavior in society. Ultimately, the message is simple. Money is not just stored value. It is a system of trust that must constantly be maintained. Banks are part of that system, but understanding it gives you something more powerful than fear: clarity, awareness, and control over your decisions. When trust in a financial system weakens, even strong economies begin to feel pressure. It doesn't always start with collapse. It often starts with hesitation. People delay spending, companies delay investing, and that hesitation slowly spreads through the entire economy like a silent slowdown. In these moments, communication becomes more powerful than money itself. Clear information from banks and governments can stop panic before it grows. But unclear messaging or silence can make uncertainty even worse, turning small concerns into large-scale fear. Digital banking has made money faster, but also more sensitive. A single rumor can travel across the world in seconds. That speed is powerful in normal times, but during fear, it can amplify panic faster than any previous financial system in history. Despite all risks, the system survives because it is constantly supported by rules, institutions, and collective behavior. People continue to trust it not because it is perfect, but because it has mechanisms to recover from shocks and restore balance when things go wrong. Every financial crisis in history has reinforced one truth. Systems built on trust can break, but they can also rebuild. Recovery depends not only on policies, but on how quickly people regain confidence and resume normal economic behavior. Understanding money is not about predicting the next crisis. It is about recognizing how systems behave under stress. When you understand that, fear loses power, and decisions become more logical even in uncertain conditions. Most people react to financial events emotionally, but long-term stability comes from discipline. Those who avoid panic decisions and maintain consistent strategies often end up more secure than those who react to every headline. In the end, money is not just about banks, systems, or numbers. It is about human behavior working together on a global scale. Every transaction is a small act of trust, repeated billions of times every day across the world. Once you understand this system, you stop seeing money as something mysterious or unstable. Instead, you see patterns, how fear moves markets, how confidence restores them, and how behavior shapes financial reality more than anything else. So if you ever look at your bank balance again, remember this. It is not just a number. It is part of a living system built on trust, behavior, and confidence. And the real advantage in life is not just earning money, but understanding how that system works before others do.